Ever walked into a Canadian bank, full of ambition, ready to launch a side hustle, invest in a new skill, or finally start that business you've been dreaming of? You lay out your plan, your numbers are solid, you've done your research, and what happens? The bank manager smiles politely, maybe nods a few times, and then pivots. They'll ask, "But have you considered a new car? We have amazing rates on auto loans right now." Or maybe they'll push a line of credit for home renovations. Anything but funding your actual plan to build wealth. This isn't just a frustrating one-off experience, it's not a mistake. It's the system working exactly as it was designed. Think about this. In Canada, it's often significantly easier to get a $50,000 loan for a brand new car and asset that starts losing value the second you drive it off the lot than it is to secure even half that amount, $25,000, to start a business that could generate income for years. Why? The common answer you'll hear is risk. A new business is risky, they'll say. But that's not the whole story. The real reason is predictability. To a bank, a salaried employee isn't a person with dreams and ambitions. You are a predictable, guaranteed stream of payments. Your 9-to-5 job, the one you think gives you security, is actually their security. It's the collateral that guarantees your loan payments for the next 5, 10, or 25 years. You aren't just an employee, you're a human annuity, a reliable cash flow machine for the financial institution. And what do they want that cash flow machine to do? They want it to consume. Banks absolutely love consumption. They love car loans, mortgages on oversized houses, furniture financing, and most of all, revolving credit card debt. Why? Because none of these things make you financially independent. In fact, they do the opposite. They tie you down. They make you compliant, dependent on that steady paycheck to service the debt you've accumulated. The more you owe, the less likely you are to quit your job, take a risk, or do anything that might disrupt that predictable payment stream. Let's do a quick audit of the real cost of this system. It's staggering. The average Canadian over their lifetime will pay more than $400,000 in interest alone. Let that sink in. $400,000. That's not principal. That's just the fee for borrowing. And this isn't because people are being financially reckless. It's because they're being what the system defines as responsible. They're buying a home, getting a car, using their credit cards, all the things we're told are normal milestones. But interest isn't just a fee for a service. It's effectively a private tax. It's a tax you pay for being predictable, not for being wealthy. It's the price of admission to the middle-class lifestyle, a lifestyle funded by debt. The system is designed to keep you on a treadmill, running just to stay in the same place, while a significant portion of your earnings is siphoned off as interest payments. So why are banks so hesitant to fund a business? Why do they label entrepreneurs as high risk? It's because a successful business creates independence. It breaks the cycle. When you generate your own income, you are no longer a predictable T4 slip. Your income might fluctuate, but you also have unlimited upside. You're no longer dependent on a single employer. This independence shatters the bank's most valuable asset, your predictability. When you're not predictable, you're not as profitable to them in the long run. This is what I call the salary ceiling. As long as your income is linear and predictable, your options for building real wealth are severely capped. You can get raises, you can get promotions, but you're still playing within a system that's designed to extract wealth from you, not help you build it. The system will gladly fund your spending, it will fund your lifestyle, but it will actively resist funding your escape plan. So, how do you break out? How do you escape this cycle? It requires a fundamental mental shift. It's a shift from thinking about affordability to thinking about ownership. Instead of asking, can I afford the monthly payment? You need to ask, will this asset generate income or will it cost me money? It's a shift from consumption to capital creation. Every dollar you spend on a depreciating asset or pay in interest is a dollar you quantize invest in a real asset. And what are those real assets? It's about turning your income into capital. Every dollar that you not paying an interest to a bank, is a dollar that you can put to work for yourself. This is where you use the tools that are available to you to build wealth, not just maintain a lifestyle. We're talking about maxing out your TFSA, your tax-free savings account, where your investments can grow completely tax-free. We're talking about contributing to your RRSP, your registered retirement savings plan, to reduce your taxable income and save for the future. We're talking about investing in stocks, in real estate that cash flows, in your own business assets that build equity and generate more income. Remember this crucial point? True wealth isn't built by getting approved for another loan. It's not about having a high credit score so you can borrow more. It's built by being intentional. It's built by consciously deciding to stop being the bank's most predictable asset and starting to build your own. It's about paying yourself first, not the bank. Redirect that $400,000 from the bank's pocket into your own portfolio. It's how you win the game. It's not easy, and it goes against everything we've been taught. But it's the only way to build true financial freedom. Thanks for watching. If this perspective resonated with you, hit that subscribe button, and let's continue the conversation in the comments below. Out. See you in the next video.